Hello, welcome back to another episode of Not Financial Advice. Today we're going to be taking a look at Best Buy and its stock price and see if we can figure out what a fair value for this company is on a per share basis. I hope you'd like the video and subscribe to the channel, and we will dive right into it. So, currently, Best Buy is trading for $70 a share. And if we just look at its stock price chart, all time, what we can see is this is a volatile stock, and just looking at a basic trend line, we might have reasons to believe this stock is undervalued at this time. And so, what we're going to do now is we're going to take a look at the $70 stock, and we're going to see if we can get an idea of the fair value of its shares on a per share basis looking at free cash flow. But it is helpful to know that the stock is down 49% from its all-time highs. It has not done a lot in the last 5 years. In fact, if we look at this here, this is just a little bit of amateur chart reading. But what you can see here is this range. So the stock has been trading up and down flat for about 5 years. When you see that in a stock's price on a chart, that indicates that there might be a large move in one direction or another coming. So the question is the stock price likely to move up or move down? But if we just look at this, $50, essentially a $50 support level, um, it doesn't want to go. It does not want to go much lower than about $50. Every time it hits anywhere close to that, it's going up. And so we have higher lows, which is a good sign. We're seeing a lot of higher lows. And so the stock price is down 49% from all time. Let's jump over to Best Buy's website. Most of us have been to Best Buy. We're familiar with it. Um, so it's a retailer. They sell TVs, they sell things like iPhones and tablets. They've just recently stopped selling DVDs and Blu-ray discs. But a big area of growth for them is also in medical technology, so smartwatches and other things. They have a loyalty program, they have online shopping, they have, order and pick up. They have a new Amazon Prime style subscription model with a lot of perks. So there's a lot of good things they're doing on a corporate level to improve the company, but we can just sort of get an idea of some of the different products that they sell here. A big thing for Best Buy is appliances, and it's actually part of my thesis on owning this company is that mom is always going to want to go put her hands on a washing machine or a fridge before buying it, and that Best Buy is a nice enough establishment, nice enough retailer that a lot of people do choose to take their business directly there to a retail location. So stock price is trading for $70. Let's figure out what this thing is worth on a per share basis. We're over here on Qualtrum. Um, as always, this is a site that I pay for to look at stocks, not one that I'm affiliated with. So I'll leave a link to Qualtrum in the description below. But I will ask you to like the video and subscribe to the channel. And what we're going to do now is we're going to start looking at some of the financial metrics behind this stock that matters. We're going to see what we can determine here. So it's a $15 billion market cap company. So I would say this is sort of it's a smaller large cap. I would say it tends to be more so on the value side. Huge free cash flow yield of 9%, absolutely huge. Um, what we can see here, looking at cash and debt, is they're not overly leveraged. They've got more cash than they do debt, and we can see a really high starting dividend yield of 5.4% with a 63% payout ratio. So that's a little bit high. Um, let's start with dividends and see if they've ever done a dividend cut in the past. Doesn't look like it. Doesn't look like it. So dividend growth of 18.4% a year over the last 10 years. So this appears to be a pretty solid dividend stock. The starting yield's a little bit high, but I think that could be attributed to the price being down 49% from all-time highs. So this is probably safe, but if you needed to rely on the dividend, I wouldn't put all my eggs in this basket on a dividend basis. But looking at this stock as far as revenue goes, we see an interesting picture. So, um, it just looks kind of flat. Looks like the company peaked in 2012, which was a long time ago. And now it's just sort of flat. But I see a little bit of a different story here. So when I look at the revenue on this company, I go back 7 years, going from 2017 to the data we have for 2023. This is an increase of 2.5% a year. And so what happened in what happened in 2017. It may be when a new CEO came along. It may be when they embraced online retailing. It may be a combination of things. They may have closed a lot of underperforming stores and remodeled their best performing stores. But this is a turnaround play that's in action, I believe. 7 years of 2.5% revenue growth after seeing some really big declines. I think the revenue looks pretty all right. So let's also take a look at the free cash flow. And I'm going to ask you to like the video, subscribe to the channel if you haven't already. But what we can see here is a pretty good looking free cash flow chart. And so we see that it's up and to the right. Um, I guess if we just go back 10 years to 2013, we can see that the free cash flow has grown about 2.9% on a yearly basis. Um, COVID was a good time for this stock, but looking at 2013 was $568 million of free cash flow. And now we're up to just under 800. So the chart is up and to the right. And to me, the free cash flow in this company looks pretty good. It is a consumer defensive, which means it's a cyclical stock, but I like the way that that free cash flow chart looks like. I certainly do. So what we can see here, just sort of looking at the cash and debt, we can see that they've paid off debt from 2014 to today's date. And they consistently have maintained more cash than debt. So it's a really strong indicator of a decent investment. Looking at shares outstanding, we love this. So they're buying these down as the price of the stock has gone down. Um, and just in general, this company's bought back about 4% of its shares on an annual basis. So any shares bought a few years ago, you now own a larger proportional piece of the business today than you have when you bought the company. Looking at return on capital employed, it seems like this is a pretty high number. It seems like they're doing over 20% return on capital employed, and they're hitting that pretty easily. So this looks really, really good. This is a very profitable company as far as taking our investing dollars or bonds that they sell and turning that into free cash flow. So a very efficient company when it comes to converting um, capital into profits and free cash flow. So all that looks pretty good. $70 stock. I'm going to ask you to like the video, subscribe to the channel. And the next thing we're going to do is get an idea of what the $70 shares of Best Buy may be worth on a per share basis. So we're going to come over here and take a look at our uh, our rough DCF valuation tool. And so what I've done is I've averaged the free cash flow over the last 5 years. So $2 billion a year in free cash flow. The most recent figure I had when I compiled this, they were in a little bit of a higher cash to debt position, but this is still for the most part accurate. So I inputted that data there. It's a company that carries less debt than cash. Shares outstanding, 217 million. Now, what we've seen is growth has looked flat over the last 10 years, but over the last 7 years, it's grown at a 2.5% rate. So I went super conservative on these assumptions and just assumed a 1% growth rate across the board with a 10% discount rate. So $70 stock, fair value, $110. So that would suggest that the stock, based on conservative assumptions, is about 36% undervalued today. It's one of my top 10, if not top 5 positions. I own it. I'll continue to own it, adding to it when and where I can. And that covers it. So Best Buy stock is a smoking steal, at least to me. This is not financial advice. Thanks for stopping by, and I will see you on the next one.